Greetings, folks. Welcome to the weekly wrap-up. It is Friday, August 26, 2022. Hope everybody's having a good day out there. Pretty ugly day in the markets, but I think this was kind of expected for those who are paying attention to what's going on with the Fed meet. Well, it's not really a Fed meeting. It's a Fed symposium in Jackson Hole, but everybody's been wringing their hands all week about what Jerome Powell was going to say, what he's going to do, or I guess what he's going to telegraph for the next few Fed meetings as far as interest rate increases. So we'll see. Evidently, the news was basically what most of us thought it was going to be, that inflation's not going anywhere, and they're going to have to continue to ratchet up rates. So again, today we're going to go through how the market did this week, go through all the economic data that was on the schedule this week. And I got a couple articles and also got a video at the end. It's from, let's see, comes from, it's a global macro update from Malden Economics. And we're just going to watch a couple minutes. It's about 30-minute plus video. But I would suggest watching it at your own leisure because it has some really good information from a global perspective of what's going on in the world. So, all right, well, let's go ahead. Let me stop. If it's your first time watching, please give me a big old like, thumbs up, subscribe, all that good stuff. Crush that like button. I would greatly appreciate it. Let's go ahead and dive in and see how the markets did today. Pretty much a bloodbath. Looks like most of the U.S. indices are all down more than 3%. Starting off with the Dow Jones, it was down 3.03% or 1,008 points. Closed at 32,283. S&P 500 was down 3.37%, closed at 40.57. NASDAQ down, the worst of them all, 3.94%, closed at 12,141. It was down almost 500 points. Small caps were down over 3% also. The VIX was up 17.36% today. It's currently sitting at 25.56. And again, my view of the VIX, anything below 20 is, green light. We're safe, or not safe, but very few things to worry about. You get from 20 or above 20, but below 30, that's kind of your yellow light. Proceed with caution. And when the VIX gets over 30, typically there's some pretty bad things that are going on or on the horizon. So you may want to, plan accordingly. All right. Other exchanges here in the Americas. Canada was down 1.48. Brazil down 1.09. Let's see here. Mexico down 0.95. Jumping across the Atlantic. Germany down 2.26. UK down 0.7. France down 1.68. Euro Stoxx was down 1.93. Netherlands down 1.83. Spain down 1.51. Italy down 2.49. Switzerland down 1.1. And Portugal was down 0.65. Moving further east, Russia, the MOEX was up 1%, while the RTSI was flat at up 0.03. Headed over to the Asian markets, they look pretty mixed. Japan was up 0.57, Australia up 0.79, New Zealand down 0.15. In China, the Shanghai was down 0.31, the SESE component down 0.37. The China A50 was flat at up 0.06. The DJ Shanghai down 0.21, and the Hang Seng came in up 1.01% in the green, and the Taiwan weighted was up 0.52%. So like I said, the Asian markets were kind of just mixed, nothing too bad either direction, and looks like the contagion really got worse as the further west you went across the globe, and then really got shellacked here in the Americas. So not all that great, unfortunately. All right, well, let's take a peek and see how the indexes did for the week. Starting off with the Dow Jones, it's going to finish the week down 3.9%. Looks like it was pretty, it was kind of, dragging a little Monday, Tuesday, but Wednesday and Thursday were slightly up, but today just crushed that. S&P 500, it's going to finish the week down 3.27. NASDAQ going to finish the week down about 3.44%. The Dow Utilities finished the week down about 2.5%. And the Dow Transports, looks like it was the most volatile for the week, is down 2.16%. So, like I said, it is a mess out there. And looking at the bigger picture, again, we can see, this is what has occurred this year, this downslope. We've had a couple of rallies back in mid-March, in May, and then this last rally that started about a month ago. Looks like its high point was on August 17th, and since then, basically over the last week, has been other than a couple of days where it was either flat or slightly up, really got pummeled today. So, and then also looking at the S&P 500 chart, again, very similar, several rallies, bumping off this line of resistance. And, like I said earlier in the week, don't let this rally get ahead of itself. It's probably going to run out of steam, and looks like it finally did. All right. Well, let's go ahead and look at the economic data for this week, starting off with initial jobless claims. They came in at 243,000. Forecast was 253,000. So a little bit better than forecast. Last week's numbers were revised down from 250 to 245. Continuing jobless claims came in at 1.415 million. The forecast was 1.442 million. Last week's numbers were revised down by 3,000 from 1.437 to 1.434. So again, this still looks pretty stable. I know we've had an uptrend over the last couple of months, but nothing too terrible. I know a lot of the headlines I've covered have talked about layoffs that are planned or ongoing, but doesn't appear to be dramatically hurting the job market right now. The Composite Purchasers Managers Index came in at 45. The forecast was a 49. And looking at the chart, we can see really since about, April or May. Yeah, it looks, I guess this was April, was kind of the high point for this year. And we've been on a nice, steady downtrend on this chart for the last couple of months. New home sales came in at 511,000. The forecast was 575. Again, it looks like we kind of peaked out in March and January. And since then, we've had this nice steady downtrend. Looking back on the longer trend, certainly not as bad as it was after the financial crash of 2008 and 9, where new home sales were bottoming out in the high 200,000s. But hey, we're getting there. Certainly not good news to see that slow down. Durable goods orders month over month came in flat. Forecast was 0.6. And the GDP for Q2 was revised to the better from a negative 0.9 to a negative 0.6. So slight improvement, but we'll see what the number looks like when it comes back out in a month from now. They'll probably have a final number for Q2. All right. Let's go ahead and read through today's market recap. S&P 500 Slumps says Powell triggers ugly tech sell-off. Yeah, Jerome Powell did this. It's his fault. The S&P 500 slump Friday, driven by a meltdown in tech after Federal Reserve Chairman Jerome Powell signaled that higher for longer interest rates would be needed to rein in inflation. Powell said the Fed's mission to stabilize inflation was unconditional and would require, quote, maintaining a restrictive policy stance for some time, even, end quote, even if that results in, quote, sustained period of below trend growth, end quote. The remarks arrived just as the latest data showed that personal consumption expenditure, the Fed's preferred inflation gauge, slowed in July. The Fed's chief didn't provide any fresh clues on whether the central bank is leaning towards a 50 or 75 basis point rate hike, but said the decision would, quote, depend on totality of the incoming data and the evolving outlook, end quote. Treasury yields climbed following the pushback from Powell, denting sectors of the market with higher valuations, such as tech. Alphabet down more than 3%, led big tech lower, followed by Meta Platforms and Microsoft Corporation. Chip stocks were also hit hard as NVIDIA Corp on Semiconductor and Marvel Technology fell sharply, with the latter further pressured by guidance that fell shy of Wall Street estimates. Marvel's guidance was weighed down by, quote, supply issues that continue to constrain the company's ability to ship to customer demand, particularly in enterprise networking and increasingly in data center cloud, end quote, Goldman Sachs said in a note Friday. Bank stocks were pressured by a deeper inversion in the Treasury yield curve, which keeps a lid on lending margins, paced by a decline in Synchrony Financial, SVB Financial Group, and T. Rowe Price Group. On the earnings front, Workday eased from session highs, but was still up 3% after reporting quarterly results that topped Wall Street estimates. Ulta Beauty, meanwhile, delivered upbeat annual guidance and quarterly results that were ahead of analysts' expectations, led by better than expected 14.4% jump in same-store sales amid ongoing demand for beauty products. Its shares, however, fell more than 1%. So they did everything right. Their numbers look good. A jump in sales. And their share price still fell by 1%. Farfetch jumped more than 26% after reporting a narrower than expected loss, driven by revenue that topped analyst estimates, underpinned by a boost from acquisitions. See, and there again, they didn't hit their they jumped 26%, but had a narrower than expected loss. So that's, again, crazy. The markets are all over the place right now. In other news, Moderna filed a lawsuit against Pfizer Inc. and BioNTech, alleging that the duo had copied its messenger RNA technology when developing the first COVID-19 vaccine. So now we got these two fighting. It's kind of like watching the Democrats and Republicans fight. They're all on the same team. They're just thinking they're on opposite sides. Anyways, all right. Next up, got an article here about Chairman Powell's statements. Fed Powell says taming inflation could lead to, quote, some pain. Yeah, because we feel great right now. Federal Reserve Chair Jerome Powell said central bankers' efforts to quash inflation will require, quote, a sustained period of below-trend growth that will lead to pain for households and businesses. Quote, these are unfortunate costs of reducing inflation, end quote, Powell said in a speech at the Fed's annual meeting in Jackson Hole, Wyoming. Quote, but a failure to restore policy stability would mean a far greater pain. End quote. Last year, Fed officials insisted inflation would be temporary, but high prices have persisted for far longer than they expected, something that has forced policymakers to act aggressively to cool the economy. Powell has said the central bank is determined to tame inflation, even at the risk of recession. He said Friday that the economy continues to show strong underlying momentum, but the labor market is, quote, clearly out of balance with demand for workers substantially exceeding the supply of available workers, end quote. Powell's message was that the Fed would continue to fight inflation to get back to its targeted 2% and would keep at it until the job is done. The debate is just how far the Fed will go at the next policy meeting in September. The futures market indicates a 58.5% chance of a 0.75 percentage point increase, which would be the third such increase in a row. There's a 41.5% chance the Fed makes a smaller half point increase. Quote, our decision at the September meeting will depend on the totality of incoming data and the evolving outlook, Powell announced on Friday. There's some evidence inflation is even leveling off, especially as energy prices have come down in recent weeks. I'll have more on that in a second. The housing market is also cooling as rising interest rates and high sales prices push would-be buyers to the sidelines for now. But as earnings reports from retailers showed, consumers feeling pressured by rising food prices are putting off purchases of other items such as clothing and electronics. A key set of data came out earlier Friday, the Fed's preferred measure of inflation, the core personal consumption expenditures index rose 0.1% in July from June and 4.6% for the year through July, both less than analysts expected. It was far lower than June's reading and indication inflation is cooling. The core numbers excluding food and energy prices, which tend to be more volatile. Yeah, because no one eats or uses gas or electricity. Quote, when the lower inflation readings for July are welcome, a single month's improvement falls far short of what the committee will need to see before we are confident that inflation is moving down, end quote, Powell said Friday. In current circumstances, with inflation running far above 2% and the labor market extremely tight, estimates for longer running neutral are not in place to stop or pause, end quote, he said. So he's basically telling us now that, we're going to have to keep rates really, really high for a long period of time to squash the inflation, get it back at or below the 2% target that they like to use. And so we'll see if they go back to any forward guidance. I know they had talked about that last month. All right. On the tax front, or the the IRS front, good news for seniors, RMD formula changing for the first time in decades. The IRS has good news for retirees. You can now keep more of your money in your tax-deferred retirement accounts thanks to lower required minimum distributions. For the first time in 20 years, the IRS has updated its actuarial tables that dictate how much a person is required to withdraw from his or her retirement account starting at age 72. The new tables, which now project longer lifespans, are used to calculate RMDs from individual retirement accounts, 401ks, and other retirement savings vehicles for each year. For help with planning out RMDs and meeting your retirement income needs, consider working with a financial advisor. Probably a good idea. What are RMDs and how they calculate? One of the primary benefits of retirement accounts are the tax advantages they provide. Traditional IRAs and 401ks allow retirement savers to defer taxes until they are withdraw the money from their accounts. This allows the money to continue to grow at a faster rate over time. However, you can only defer taxes for so long to limit you from keeping your money in a retirement account indefinitely. Boy, that'd be nice. The IRS requires you to withdraw a specific amount each year once you reach a certain age. Previously, you were required to start taking withdrawals from an IRA or employer-sponsored plan when you reached 70 and a half, but the 2019 Secure Act made a critical change to when RMDs begin. If you reach age 70 and a half in 2019, prior to the prior rule applied and you had to take your first RMD by April 1st, 2020. Yet, if you reached age 70 and a half in 2020 or later, you must now take your first RMD by April 1st of the year after you reach age 72. People with the following accounts are subject to RMDs: traditional IRAs, SEP IRAs, simple IRAs, 401k plans, 403bs, 457s, profit sharing plans, and other defined contribution plans. It's important to remember that Roth IRAs are not subject to RMDs. Calculating your RMD is relatively easy. First, you look up the market value of your retirement account as of December 31st of the previous year, then divide that value by the distribution period figure that corresponds with your age on the IRS Uniform Lifetime Table. For example, a 72-year-old retiree with $500,000 in her IRA would divide $500,000 by her distribution period figure, which is 27.4. Basically, what that means is she has probably 27.4 years before she will most likely expire. And that number gets smaller and smaller over time. As a result, she would be required to withdraw at least $18,248 from her IRA in 2022. Why the new RMD formula is good for retirees. With the IRS raising the average life expectancy from 82.4 to 84.6, retirees will presumably need to spread their assets over more years. As a result, RMDs that begin in 2022 will be less than they were under the previous formula, which have been in place since 2002. This is good news for retirees or anyone subject to RMDs. With smaller withdrawals required each year, more of your retirement assets can remain in an IRA, 401k, or tax-deferred account. Smaller RMDs will lessen your tax liability and could potentially drop you into a lower tax bracket. Under the previous Uniform Lifetime Table, a 72-year-old with $500,000 in her 401k would have been required to withdraw $19,531 during her first year of taking RMDs. That's $1,283 more than would have been subject to income taxes compared to the smaller minimum withdrawal required under the revised table. Meanwhile, a 72-year-old with $2 million in his retirement account would have been required to withdraw $78,125 under the older formula, $2 million divided by 25.6. However, the updated formula results in an initial RMD of just $72,992, which is $2 million divided by 27.4, meaning the retiree would keep an extra $5,133 growing tax-deferred in his retirement account. So it's small, it's not huge, but it certainly does help. All right, and last up is that video I was talking about. Like I said, it comes from Malden Economics. It's actually 38 minutes and 40 seconds, and we're starting right around the 25-minute mark. So let's go ahead and give this a watch for a few minutes. Let me turn up my volume so I can hear it too. All right.
The ECB essentially, can the ECB do anything to mitigate the inflation situation? I mean, because of the debt load of the periphery countries?
Look, what Europe will need to do, Europe's saving grace in all of this, like the silver lining, is that the oil price is actually not so high, right? The oil price is $95. Right now, if you look at the electricity cost in Europe in sort of oil equivalents, it's $1,000 a barrel. If you look at the natural gas price in Europe in oil equivalents, it's $600 a barrel. So what Europe can do this winter is just buy very large, copious amounts of oil from Middle East, from Iran, from the US, from Canada, from anybody who sell it to them, sell oil and burn it for energy, which is, of course, polluting and a stupid way to produce energy, but that's the situation we've left ourselves in.
Sure.
And so the saving grace for Europe is that oil is still not too expensive, one, and two, that moving oil around is actually pretty easy. It's much easier than moving natural gas. It's you put it on boats, you put it on trucks. You can move the oil around. So Europe this winter is going to have no choice but to buy copious amounts of oil, which is very bullish oil, of course, and pretty bearish the euro because they're going to have to pay for that oil in US dollars. So they have to sell euros, buy US dollars to buy all the oil they need. So all that is so as far as the ECB is concerned, that will make for higher inflation rates. Weaker euro, higher oil. Inflation rate in Europe isn't done falling. So what can the ECB do in the face of this? I don't know. I think it's Jim Grant always says, what would you do if you were chairman? What would you do on your first day if you were chairman of the Fed? And he always says resign. That's what I would do if I was chairman. That's what I would do if I was chairman of the ECB.
So we've covered a lot of ground. Let's wrap this up by talking about what would you recommend to an investor in terms of positioning. A world where baseline inflation is going to be higher than we've experienced for decades. Interest rates are going to be higher than we've been used to for certainly the last decade. Energy constraints. What is an investor to do?
Look, I think the first thing to acknowledge is that building a good portfolio, and I know I've talked this at SIC conferences in the past, but building a good portfolio is like building an American football team, right? When you put your American football team on the field, you need players to do different things. If you had a team with 11 John Elways or 11 Dan Marinos, sure, you get pummeled every day of the week. So your offensive linemen do a job, and your running backs do a job, and your quarterbacks do a job. And the same is true of a portfolio. Now, the big challenge for investors today is that for the past 30 years, the offensive line, i.e. the anti-fragile part of your portfolio, the part of your portfolio that protected everybody else, used to be government bonds. It used to be U.S. Treasuries or German bonds. So that was your offensive line. And that offensive line no longer works. And you've seen this very clearly in the past year, right? In the past year, in the first 6 months of this year, S&P 500 goes down 20%, and the TLT, the long-dated U.S. Treasury ETF, also went down 20%. And it was like one for one. It was providing no diversification, no protection. So it's a little bit like, you send off your offensive line on holiday and they came back and they all weigh 120 pounds. They all went on massive diets and they all became cross-country runners, which is great if you want to win a cross-country competition. Not so great if you need an offensive line. So the first thing to acknowledge is that bonds no longer do the job in portfolios that you want them to do. So you need to sub them out. If you have an offensive lineman who's not doing the job, you need to take him off the pitch and put somebody else. Now, what is the new anti-fragile asset today? What is the asset that basically behaves with a negative correlation to everything else? I think there's really two of them left. The first is energy. I'm sure you'll have noticed that all year long, days where the market is up, energy is sort of struggling. Days when the market is down, energy is doing well. So energy, which makes sense in an inflationary environment, right? Because today the risk as an investor, I know we're all focusing, and I am as well, on is Powell going to be hawkish at Jackson Hole? Is he going to be dovish?
Right.
Ooh, is it going to be 50 basis points? Is it going to be 70 basis points? 75 basis points? Forget it. Like in 10 years' time, in 5 years' time, this won't matter. What matters is oil going in the next 6 months? Is oil going to $150 or to $50? I mean, that's it. That's what matters. And if oil goes to $150, the rest of your portfolio is destroyed. And that's the same.
All right, I'll go ahead and stop that there. And I guess probably the biggest thing I would take from who was this guy talking? This is Louis Gave from Gavical Research. He's the CEO. The first part where he's talking about, the pickle or the corner that Europe has painted themselves into as far as energy. They talked earlier in the video about, you really don't see a lot of inflation in places like Japan, China, But everywhere else where energy has gotten just so far out of control, we're seeing, really, really high levels of inflation. And, what I've said from the beginning is that we really won't see a lot of inflation help or reduction until we get energy prices under control, because energy affects everything. And what he's saying is, with the winter that's coming up, the European Union is basically just going to have to buy oil from wherever they can get it from, because they're not getting the natural gas that they were getting through Russia in previous years. So they're going to have to burn a lot of oil and gas, or oil, to heat and energize the European Union. So do you think oil is going to go down in price substantially over the next 6 months? And then there at the end, what he's talking about as far as what used to be our safe investments, and I put those words safe in quotes. The bonds, especially government bonds, they were typically, you weren't going to make a huge return on them, but they also weren't going to get pummeled when the market got all topsy turvy. And it's been the opposite in the last year or so. So his big one is energy is kind of your safe bet at this point, where it moves in, doesn't move in relationship with the overall equity market. And the second one that he talks about in a few minutes is emerging market bonds. So also just some food for thought. So like I said, it's about a 40-minute video, or just under 40 minutes. I put it on 1.5 speed, which is what we were listening at here. You can blaze through it pretty quick. Put your earbuds in while you're doing some chores or whatever the case may be. But it's always a good listen. John Malden's group always puts together fantastic data and information. So, all right. Well, that's everything I had for today. Sorry I went a little bit long, but I wanted to cover that video, and hopefully you get something out of it. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. And hope everyone has a terrific weekend. And I'll be back on Monday with the weekly economic update. Y'all take care. Bye.